Welcome to Neighbourhoods, I'm Tom Ritchie. So, did you know that Canada has one of the highest home ownership rates in the entire world? We're going to find out why that is when we return. Welcome back to Neighbourhoods. So today, I'm joined by two suits. And these guys are obviously in the finance industry. Great looking guys, Jason Neziol of Genworth Canada and Mike Rogozynski of OMAC Mortgages. Thanks guys for joining me. Today we're going to discuss mortgages, all the different options. It's almost like a little rivalry when you talk to friends or family, like what rate did you get? You know, oh, I'm so sorry, you know, you got 2.6, well I got 3, and you know, that was a fixed interest. But I don't really know what I'm talking about. That's what these guys are here for. So anyways, let's first talk to you, Mike, about mortgages, okay? So how long have you been in the business?
Well, I'm in my 20th year.
Wow, but you're so young. The guy's so young looking.
I started when I was 10.
It's 10, okay,
Yeah.
perfect.
Yeah, no, I've been with OMAC for just over 19 years and love the business. So it's good business to be in.
Right. And so you've just switched. I've just noticed on all of Mike's emails it used to say there was a cup and it was a logo and it said, think outside the bank.
Yep.
Why?
Because the brokers have a lot more options available than just going to the standard bank nowadays. If they went to their financial institution, they're going to be offered that financial institution's products, and you know, it's a yes or no.
Right.
When they come to a broker, we deal with a variety of lenders, whether it be banks, monoline lenders, credit unions, insurance companies. So there's just more option and more choice for the client.
Okay. So you'd mentioned insurance, and that's Jason, obviously, why you're here. Genworth, obviously, being an insurer. Right. But explain what Genworth's role in a mortgage is.
Okay, so Genworth works with a lot of the lenders, credit unions, and brokers. We kind of work behind the scenes a little bit. So our role in the Canadian marketplace is if somebody's putting less than 20% down, they have to insure it against default. And that's the role that the insurer plays within that transaction. So we come in after you've seen your financial institution.
So you basically underwrite that mortgage.
Exactly.
Okay.
Yeah.
So now whose money is this? Because there's another insurer out there which is affiliated with Canada, the government.
Yeah.
But whose money are we talking here? It's not your money.
No, personally, no, not mine at all. So essentially what it is there's actually 3 insurers in Canada now. So there's us, Genworth Canada, there's CMHC, which is the government, and there's another one called Canada Guarantee. Okay. So we are basically, just like any insurance policy, we're insuring that mortgage for the risk involved against default for the financial institution. Okay. So it's essentially Genworth Canada's money that's backing all of those transactions. Right. Okay. The government of Canada, of course, has a government guarantee behind all the insurers. Okay. As well.
And how long has Genworth been around?
Genworth has been in Canada since 1996. Okay. So we have a long history. Right. We insure right across the country. So it's been a great ride because, of course, when we started with a 0 market share. Right. And now we're at approximately 30%.
Wow, that's incredible. So we're going to jump around a little bit just because there's so much involved with mortgages. Let me go to you, Mike. We did a segment an episode, on buying, selling, pre-qualifying, pre-approval. And I'd like you just to dispel any rumors about the pre-approval process versus the pre-qualified, because you can. Obviously, there's a big difference.
There is a difference, and a lot of lenders are actually going more to the pre-qualify route, or rate hold route, they call it now, as opposed to a pre-approval. But what a pre-qualify is basically the same process as a pre-approval in most cases without the full underwriting. So there's no actual credit report a lot of times in the pre-qualifying. So they will say, based on your income, based on your debts, this is what you qualify for. Whereas a pre-approval, that same process is involved, but then the credit report is done, and a lot of times the underwriter will underwrite it for the lending institution. So they'll say, yes, everything looks good, and here's the conditions. So it's more of a which is more formal route. Right. One necessarily is better than the other. If you have a pre-approval in a lot of cases, that client has a little bit better backing when they go in to purchase a house, knowing the financing is there. Obviously, if it's less than 20% down, subject to the insurer approval.
Right. So how does that work though when the purchaser or the borrower does not know which house they're purchasing? Are you doing it based on their maximum amount allowed to borrow? Or
yes, I usually look at my clients in 2 different ways and ask them what the maximum is that they want to purchase, or do they want to find out the maximum amount. Okay. And sometimes a client will have a maximum amount in mind already, and otherwise they just want to see what they qualify for. Right. So it's a generic approval based on again, those income factors, debt factors, we have to throw in a factor for property taxes. So that's usually an estimate.
Okay.
And then we put in a component for heat as well.
Okay, okay. So, and then a pre-qualify, obviously, Jason, your company gets their hands on it because they can actually underwrite that prior to. Is that correct?
Well,
Am I understanding it right? Or?
We, as the insured, we don't receive the transaction until there's an actual offer on a house.
Oh, okay, okay.
Because we need to look at the full picture, which is, of course, the borrower and the property that they're purchasing, because we underwrite the whole thing. Now, a lot of times we will work with the lenders and mortgage professionals, and they'll put scenarios by us, and we're very open to have conversations around what the situation is for individual clients. Individuals like Mike that have been in the industry for years, they pretty much know where Genworth is going to fit in their guidelines, and whether they have a client that's going to not have a problem or may need a little bit more coaching around understanding what they can afford.
So what can a borrower expect? I'm just coming into your office, Mike. I'm putting 5% down. Can you still get away with a 5% down mortgage?
Yes, you can.
You can. Can I get away with a 0% down mortgage?
No.
No. Okay.
There are programs out there to assist with down payment financing, or down payment assistance is what they call them. They're underwritten under strict guidelines. And obviously, in a lot of cases, they're subject to a higher rate if it's a cashback option. But also, if the client is very good at managing their money, they have access to some credit, they can borrow their down payment, provided we factor the monthly payment, minimum payment, back into the qualifying. But again, those are more credit-driven than, say, a standard mortgage in some cases. So it is an option that's still there.
Okay, so I back up then, and I come in with 5% down. You do everything you do on your end. You send it off to Jason's company, Genworth. Okay.
Well, we would send it off to the lender.
To the lender.
And then the lender would.
And then the lender
sends
it. Okay. So that's the process. I had it wrong. Mike corrected me. That's why they're here. That's why they wear suits, because they know they're smart guys. Anyway, so it ends up at Genworth. And what can a borrower expect? What's the long run cost? Like, what percentage are we talking here?
Right. So essentially, what a client will look at paying if they're putting 5% down is 2.75% of the mortgage amount built into the mortgage. Clients have two choices. They can build the amount of the premium into the mortgage, or they can pay it in cash. And quite frankly, I think in my life, the 14 years I've been with Genworth, one person's paid it in cash.
It wasn't me.
No.
Normally.
Normally. So they roll it all into the mortgage itself. It's a one-time fee that they pay. And the great thing in Canada is once you've purchased that house and you've paid that premium, if you go and buy another house and you have to go high ratio again, there could be an opportunity for you to port the original premium you paid. So you can save down the road as well. And a lot of clients don't know that. So that's a great question to ask your mortgage professional when you're in with them if you already have an insured mortgage.
Okay, awesome. So we're actually going to run to break, and then when we come back, we're going to discuss how Genworth can help new ownerships, or new home ownership.
Excellent.
Okay? We'll see you when we return. Hi, I hope you're enjoying this episode of Neighborhoods, but I do invite you to check out our Facebook page where you can get information on past and future episodes. But not only that, you can win some great prizes from our sponsors like the Woodstock Fitness and Racket Club. Stay tuned right here on Rogers TV. Welcome back to Neighborhoods. So today we're discussing mortgages, if you're just joining us, and I'm joined by Jason Neziol. Neziol. I'm going to get it right one of these times. And Mike Rogozynski. Mike is obviously with OMAC, and Jason is with Genworth Canada. So before we went to break, I had mentioned that I wanted, or even on break, we were discussing how Genworth helps new home buyers realize the dreams of home ownership sooner. Explain. Go on that for me.
Well, I mean, I think a lot of your viewers can relate to this, is that in order to purchase a house without mortgage insurance, you need 20% down. If you look probably in the southwestern Ontario area, the average price point is, $250,000, $260,000. So you've got to have, maybe $50,000 in order to wait if you want to avoid an insurance premium. We allow people to buy with as little as 5%. So individuals getting out of university, getting their first job, newly married, who haven't had an opportunity to save up 20%, allows them to get into home ownership, allows them to start building equity in a house sooner, and realize that dream of owning their first home, which goes to the stat that we talked about at the beginning of the show, is Canada has one of the highest home ownership rates.
Is that attributed to that?
I think it's attributed to a few things. I think home ownership is very important to the Canadian population.
Right.
They want to own. They've watched their parents own. So in a large cases they do. And there are a lot of programs and a lot of access to credit in Canada where you can have that opportunity to own sooner.
Okay. So let's say, Mike, we've discussed this in the past with other clients, but I want to purchase a property that needs improvements, and Genworth plays a role in this as well.
Absolutely.
So it's something called Purchase Plus Improvements Program. Right. And is that through a lender or is that through a company like an insurer like Genworth?
It depends. Some lenders don't offer the program, but the majority of lenders do, and it would be through the insurer as well. So basically the client would go out, purchase their home, and let's say they wanted to do a roof.
Right.
They would have to get a quote for whatever the roof cost is.
Okay.
When we package it up, we send it the Purchase Plus Improvement price to the lender. Down payment is all based on that amount. And then they'd send it to the insurer for their approval. If it's insured and approvable, comes back. What happens on closing date is the lender will advance enough money to close the transaction, and they'll do a holdback for the improvement amount.
Right.
Once the improvement's done and it's confirmed, then at that point those funds are released to pay the contractor, and it's all built into the mortgage, which is a nice advantage of one low rate, one payment, rather than having to go search out some alternative financing for that improvement.
Okay.
Absolutely.
Jason, do you have anything to add to that? Like, how does that? So, I guess what I'm trying to get at is not all hope is lost. So when I work with a client, we'll go out and if there's a house that needs a roof, like you mentioned, needs a roof, maybe needs a bathroom, there's still a chance for them to own that, but in their minds, they're thinking, I need to find something that the bank is okay with or the lender is okay with because I'll never get a mortgage, but that's not the case.
No, absolutely. I think you look at a lot of individuals who are maybe buying for the first time and walk into a house, and a lot of the average stock in southwestern Ontario is anywhere 25, 27 years old. So if you're buying a house, you're not necessarily going to look at that bathroom and say that's perfect. I want that bathroom, or I want the kitchen in the colors they have in there. So it allows somebody that has a smaller amount of a down payment to go out, like Mike said, get the quotes. You might want to, let's say the kitchen's going to cost you $15,000 to upgrade. Well, your one solution is to purchase the house and then go and look at doing it on a line of credit or other savings that you may have in order to do that kitchen.
Okay.
Or you can roll it all into the value of the home. We may have to appraise it and look at where the value is going to come out.
Yeah.
But now you're putting 5%. You're only putting 5% of the $15,000 plus the mortgage down,
Right.
as
That's a
opposed to
great
having to come up with all of the money.
Sure.
And it's great for the housing stock too, because it updates a lot of the older housing stock
So the
as people
values
move
go
in.
up as well,
So the
then.
values go up as well.
Great. So let's talk a little bit about immigrants and people moving to Canada. Can they purchase a home? Like a lot of people are moving in and they don't have an employment right away, but there's a program that Genworth, along with certain lenders, I'm assuming, offers so that these people can realize their dreams of home ownership as well.
Yeah.
And what is that program? How does that work?
So essentially, it's a program that's called New to Canada. New immigrants into the country who have been here for a short period of time can actually qualify to put as little as 5% down on the home.
Okay.
Now, they do have to have employment, and they do have to be past a probation period. So there are some guidelines around what we are looking for and a track history in terms of how they've paid their credit, if they've come from abroad, if we can get that.
So you can track that. So if someone comes from Scotland, for instance, they move here, you can actually track their credit history and payment history there?
Depending on, Mike might talk to that, but depending on which country they arrive from, the United States is a great example. They have the same credit bureau as we do, so we can get credit from there.
And sometimes if it's an international country, the international credit reports can be very expensive.
Okay.
Some of the lenders will accept reference letters from the institution they dealt with in the country that they're coming from. So, it's more of a case-by-case basis if it's not, let's say, from the United States, where we have access to that bureau at a relatively reasonable cost.
Okay. So we're going to go to break, and when we return, I want to talk about, Mike, we've done a few deals in the past, and you always say, pay your mortgage, right? Mike almost always finishes with this, just make sure you pay your mortgage. But I want to talk about default and what happens to that property or to the homeowner when we return. So stay with us, we're going to be right back. Welcome back to Neighbourhoods. So before the break, I mentioned that I wanted to discuss default. What happens to the people in the houses? What happens to the mortgage? What happens to the house? So I don't know where to take it from, but maybe Mike, you can start.
Well, depending on the stage of the default will determine a lot of course of action as well. We always tell our clients, you made a point of saying, they say, pay your mortgage.
Yeah.
And I do mean that, if they, at all possible, pay your mortgage. And most people will pay their mortgage before anything else. But there are cases, yes, where they fall behind. The thing we always like to tell our clients is, if you're experiencing any hardship, don't be afraid to call us or call the lender. Mm-hmm. If you're at least willing to bring the problem to the light of the lender and the broker, we'll try and work with them as much as we can. Failing which, it doesn't work out or we can't come up with a comparable solution, then the insurer would get involved. I'll let Jason talk about what Genworth would do in that case.
Okay.
Yeah, absolutely. Like in the case where the mortgage is originally insured by us, and the clients come on some financial hardship, maybe an illness in the family, we will take the information from the lender or the broker, reach out to the end consumer, talk to them about their particular situation that they're in, and if at all possible, we'll help them kind of transition through that time period. So it may be they want to capitalize some payments. We've done shared payment programs with the clients so that they can transition through that time. And we were talking during the break, when the recession hit in 2008, we started to see a lot more of these. So right now we're seeing approximately about 5,000 workouts that we do every year across Canada.
Yeah.
Ontario
Still,
being the highest.
And I think one of the things that Mike touched on was that, if you're in trouble, call. And what happens is a lot of people feel ashamed. They get into a position where something has happened and it's beyond your control, but just call. Call and speak to someone is 10 times better than avoiding the phone when it's the lender or Genworth calling. Yep. Just call, and there's something, and that's amazing that Genworth will actually work with the person in that need and help them to figure out a solution.
Oh, absolutely. I mean, we do say that we help those individuals get into their home, and we want to help keep them in their home.
Sure, and it's probably more feasible to Genworth to help keep them in the home than to take that property back.
Oh, absolutely. It's a big benefit for the lender, for the consumer themselves, for the neighborhoods that they live in, that those homes stay occupied and those people are able to continue on with their mortgage payments. But you made a great point, is if you know that something's happening and occurring, call somebody immediately, whether it's your lender, whether it's your mortgage professional you worked with, whether it's us, and advise us early, because it's a lot easier to help when the mortgage is maybe 2 weeks behind or 3 weeks behind than 3 or 4 months behind.
Okay, so as a realtor, I get a lot of calls. I want to see some power of sales. Everyone thinks that the power of sale is the deal to be had, and in some cases, they're okay. I sometimes, you go in and you remember that this family was in hardship. Something happened here, but what's that process? Someone hasn't called you. They're avoiding everything. What happens? What is the process?
Yeah, I mean, there is a stage where the lender will work with the consumer as well, and it's usually we gain a property or a power sale through the lender.
Right. So
the process is a little bit more difficult for me to talk to when it actually becomes a power sale.
Right. What can someone expect, Mike, if they've stopped making their payments? How long are they going to be? I'm not saying that anyone can do this, and it's not endorsed, especially by Neighbourhoods or myself or these two gentlemen. But how long does it take? How long can someone expect to be in their house, stop making payments by the time they're kicked out?
Usually, the power sale proceedings with the majority of lenders, I'm going to say, will start about 3 months after payments have not been made. Right. But then it has to go through the legal process where the court gets involved. They get served papers by the sheriff, and then it really depends on the lender. Some of them will start right away, and some of them will take 6 months, 7 months. It's not something that I can say set in stone, here's how it's going to work. Okay. Usually when it gets to that stage, we're out of the transaction anyway. We don't get any more advance notice unless a client's coming to us. And I've had that too, where a client comes and says, here, I got the papers that say I have to be out in 30 days. I need your help. Right. At that point, as we said, that's a little too late to try and get assistance in a lot of cases. Not to say we haven't been able to help, but it becomes more costly for the client for sure.
Okay, I don't want to end up ending the show on this kind of down note. So let's talk about some, excuse me, some really good statistics. So some of the stuff, Mike, you sent me, it's an average 69% have fixed rate mortgages, okay? So just quickly to explain what's the difference between a fixed rate and a variable rate mortgage.
Well, the fixed rate, obviously, for the term that they're choosing, their rate and payment are guaranteed for that number of months that they've selected. The variable rate, the rate is going to float according to the Bank of Canada prime rate, minus whatever discount they may have if they do have one. So the fixed rate just offers the stability. The variable rate's for more of those clients who have a risk tolerance, maybe a seasoned veteran in the mortgage industry. They're willing to ride out the highs and the lows. In Canada, the prime rate's been very low for quite a while now, but we're expected to see some increases probably in 2015, depending on which economist you listen to. So there was a trend when the rates were really low for people to go to fixed rates. That's why you're seeing the high stats. Once that spread between the fixed rate and the variable widens, the trend seems to shift back to variable, and we're seeing a lot of people looking at variable rate mortgages again. I think people are accustomed to the low rates, and that's what's in their mind. Now, whether or not a variable is good for everybody, ultimately the decision's theirs. They have to qualify at a higher rate than on their fixed rate mortgage, if it's a 5-year term, for example. So there are some buffers built in to help out those clients as well.
Okay, so Jason, how long are the rates going to stay low? Can you answer that for me? Are they going to stay? Are they going to stay down? Will they stay?
Well,
under
I wish
4%?
I could answer that definitively. Yes, yeah, you're going to hold me to it. I mean, everything is saying that the rates are going to stay low for a significant amount of time, meaning probably definitely into next year, is what they're saying. It's going to give individuals time to look at what they want to buy. But I think what consumers need to keep in mind as well is that affordability just isn't based on how good your rate is. The banks will qualify based on something called a TDS and a GDS.
Which is?
Total debt service ratio, which is your mortgage payments, your taxes, and then all your other debt, which typically they'd like to see below 40%. And then a GDS, which is just your mortgage and your taxes, which is below 32. But what I think especially first-time homebuyers have to keep in mind is, what are my other expenses? They may say, I can qualify for this amount of a house and my TDS is rate at 40, but my car might be 8 years old and I need a new car. I may be having children that need to go into daycare, and we know how expensive that can be per month. There's other expenses that people have to keep in mind outside of just what's my best rate. Right?
What is the major, in a condensed version, because we're starting to run out of time, what is the major impact on rates? What's going to affect a rate hike?
Not being an economist, it's not something that is my background. But usually there's shocks in the system that are going to cause rates to go up, and nobody foresees that anytime soon. I mean, the overall North American market is still, a little bit fragile in terms of its recovery from the recession. So they need to keep rates low for a certain amount of time in order to, increase the amount of capital and spending and those sort of things. So, but nobody sees that anytime soon.
We'll be right back with more Neighbourhoods. Welcome back to Neighbourhoods. Unfortunately, we're out of time, but I'd like to thank my guests, Jason Neziol and Mike Rogozynski. Gentlemen, there's been so much information shared, and I really appreciate it, and I'm sure the viewers at home do too. If you have any questions regarding this episode, or you'd like to express concerns about something these two guys said today, I'm just kidding, they've been great. But my number's there. You can text me if you have any questions about real estate or anything about the episode today. And thanks so much for watching Neighbourhoods. We'll see you next time.